In November of 1963, while America was still reeling from the assassination of its president, a completely different catastrophe was quietly unfolding in New Jersey. One that would vaporize $180 million in a single week. That's over $1.8 billion in today's money, gone, not because of a war, not because of a market crash, but because of salad oil. A high school dropout from New Jersey had just pulled off the greatest commodity fraud in American history. He convinced the most sophisticated banks on Wall Street that his tanks the size of apartment buildings, were full of oil. They weren't. They were full of water. And almost nobody noticed until it was too late. This is the story of Anthony Tino De Angelis and the Great Salad Oil Swindle of 1963. To understand how this happened, you need to understand what America felt like in 1963. The country was riding high. The economy was booming, the middle class was growing. Consumer spending was at record levels, supermarkets were stocked floor to ceiling. Vegetable oil, used in salad dressings, cooking, food manufacturing, was one of the most traded commodities in the world, and the US government, in a bid to boost American exports and help struggling nations abroad, had created something called the Food for Peace program. The idea was simple. American companies would export surplus agricultural products, including vegetable oil, to developing countries. The government would back the loans used to finance those exports. It was good for America. It was good for the world, or so everyone thought. Because somewhere in Bayonne, New Jersey, a man named Tino De Angelis was reading the fine print, and he saw something nobody else did. A loophole so massive, so audacious, that it would take years for anyone to figure out what he'd done. This story matters today, not just as history, but because the exact same psychology that made this fraud possible, it's alive and well right now in your bank, in your investment portfolio, in the financial systems that govern your daily life. The names change, the con stays the same. So let's go back to the beginning. Anthony De Angelis was born in the Bronx in 1915. He never finished high school. By his early 20s, he was already running a hog butchering operation and already cutting corners. In the late 1930s, he was caught shipping uninspected meat to a federal school lunch program. He was fine. He moved on. This was a pattern with Tino. Get caught. Pay the fine, move on, go bigger. By the mid-1950s, he'd founded the Allied Crude Vegetable Oil Refining Corporation in Bayonne, New Jersey. Right on the water, right next to the shipping lanes. From the outside, it looked legitimate. He had massive storage tanks, some of the largest in the region. He had contracts, he had employees, he had the swagger of a self-made American businessman. But here's what made Tino truly dangerous. He wasn't just a crook, he was brilliant. He understood something about the commodity markets that most Harvard-educated bankers didn't fully appreciate. Nobody actually checks the tanks. Here's how the commodity lending system worked at the time. A company that owned a physical commodity, let's say vegetable oil, could use that commodity as collateral for a loan. The more oil you had in storage, the more money you could borrow. Inspectors would come, they'd look at the tanks. They'd measure the oil levels, they'd sign off. And the banks would wire the money. Simple, clean, trusted. Tino looked at this system and asked one question. What if the tanks aren't actually full of oil? This is where the story takes a dark turn. Because Tino didn't just ask the question, he answered it. He discovered that vegetable oil, being less dense than water, floats. If you pump a few inches of oil into a tank that's otherwise full of water, the inspectors, measuring from the top, will record a full tank of oil. The tanks weren't full of oil, they were full of water, with just a thin, glistening layer of salad oil on top, and Tino had tanks big enough to hold millions of gallons. But here's where it gets even more audacious. He didn't just fool the inspectors once. He built a network of underground pipes connecting the tanks. When inspectors came to measure tank A, workers would secretly pump oil from tank B underground into tank A, making it look full. Once that tank was certified, they'd pump the oil back. He was running the same thin layer of oil across multiple tanks simultaneously. One inspector, 30 tanks, one layer of oil, and on paper? Tino De Angelis, high school dropout from the Bronx, appeared to own more vegetable oil than was physically possible to exist in the United States at the time. At his peak, De Angelis claimed to own 1.8 billion pounds of vegetable oil. The entire U.S. annual production was just over 1.1 billion pounds. He claimed to own more oil than America produced in a year. And Wall Street believed him. But why? That's the question. And the answer is going to make you deeply uncomfortable. Stay with me. By 1962, Tino wasn't just borrowing money, he was borrowing enormous money. Through a process called field warehousing, companies like American Express, yes, that American Express, were hired to certify and vouch for the commodities in storage. Field warehousing was a common, respected financial practice. A third-party company would essentially act as custodian of the stored goods, issuing warehouse receipts that banks could then use as collateral. It was a system built on trust, and Tino weaponized it. The warehousing subsidiary of American Express Field Warehousing Corporation, became one of his primary certifiers. Their inspectors came, they looked at the tanks. They measured from the top, they issued the receipts. They didn't drain the tanks. They didn't cross-check the figures against national production data. They didn't ask the obvious question, where did all this oil come from? They signed the paperwork. And those receipts, backed by the prestige and credibility of the American Express name, were accepted by banks across the country as gospel. Lenders including Bank of America, manufacturers Hanover, Continental Illinois, and dozens of smaller firms handed over millions of dollars in loans, all backed by Tino's phantom oil. But Tino wasn't just borrowing, he was also trading. Using his fake collateral, he took enormous speculative positions in the vegetable oil futures market, essentially betting that oil prices would rise. If he was right, he'd pay back the loans, pocket the profit, and nobody would ever know. If he was wrong, well, that's what nobody wanted to think about. And here's the thing about financial fraud at this scale, it doesn't happen in a vacuum. Tino needed co-conspirators. He needed silence. He needed people who were either complicit or willfully blind. He had inspectors who were bribed. He had employees who knew not to ask questions. He had a culture, both inside his company and across Wall Street, that prioritized the appearance of due diligence over the reality of it. People were making money, the paperwork looked right. The names on the documents were trustworthy, and in boom times, nobody rocks the boat. That's the warning sign this story begs you to remember. When things are going well, that's exactly when fraud hides best. But by late 1963, the vegetable oil futures market wasn't cooperating. Prices weren't rising, they were falling. And Tino's positions, his massive, leveraged baits, were hemorrhaging money. He needed more loans just to cover his losses. He needed more phantom oil to back those loans. The machine was accelerating and it was heading straight for a wall. November 22, 1963, President John F. Kennedy is assassinated in Dallas. The New York Stock Exchange shuts down early. The nation is in shock. Business stops. In the grief and confusion that follows, financial institutions are distracted. But within days, as the country tries to process its grief and slowly return to normal, the cracks in Tino's empire begin to show. Creditors start calling in loans, commodity trades start settling. Money that was supposed to be there isn't. On November 19, 1963, just days before the assassination, Allied crude had already begun to collapse. By the time the dust settled in late November, the full scale of the fraud was becoming clear. The tanks were inspected. Properly this time, they pumped them out and found water. Just water and a little oil floating on top. The tanks were full of water. The receipts were worthless, the loans were gone, the numbers were catastrophic. $150 to $108 million in fraudulent loans, backed by warehouse receipts for oil that didn't exist. More than 51 companies were directly affected. Two major Wall Street brokerage firms, IRA Haupt & Co. and Williston & Bean, were so deep in Tino's commodity trades that they couldn't cover their liabilities. IRA Haupt & Co., one of the most respected brokerage firms in America, had over 20,000 customer accounts, innocent investors, regular Americans. People who had nothing to do with Tino De Angelis or Salad Oil. Their accounts were frozen. The New York Stock Exchange, in an extraordinary, unprecedented move, had to step in and bail out the customers of IRA Haupt to prevent a wider panic. It cost the NYSE member firms $9.5 million, a massive sum in $1,963, paid out to make customers whole. And American Express, the company that had certified the tanks, that had issued the warehouse receipts, that had put its name on the fraud. Its stock plummeted 50% in days. The American Express name, built over more than a century, was in genuine danger of being destroyed. Think about that. One man, one scheme, one thin layer of oil. And it nearly brought down one of the most iconic financial brands in American history. Nearly froze the accounts of tens of thousands of innocent investors. Nearly crashed the New York Stock Exchange in the immediate aftermath of a presidential assassination. If the NYSE hadn't acted as quickly as it did, the panic could have been catastrophic. But here's where the story pivots. Because out of this wreckage, two things happened that would permanently change American finance. And one of them involves a young investor from Omaha, Nebraska, who looked at the rubble of American Express and saw something nobody else did. His name was Warren Buffett, and this moment, it made him. While panicked investors were selling every share of American Express they owned, a 33-year-old Warren Buffett was sitting in steakhouses and diners across Omaha, watching something very specific. He was watching whether people were still using their American Express cards, whether waiters were still accepting them without hesitation, whether the brand, despite the scandal, still meant something to ordinary Americans. And the card was still working. People still trusted it, the fundamental business was still sound. The scandal had damaged the stock, not the company. Buffett concluded, with the quiet confidence that would define his career, that American Express would survive. He committed $13 million, roughly 40% of his entire partnership's assets, to American Express stock. It was the largest single investment of his life to that point. Within a few years, as American Express recovered and reformed, the investment returned enormous gains. It was a defining moment for Buffett's philosophy: be greedy when others are fearful. But while Buffett was making his fortune, justice, such as it was catching up to Tino. Anthony De Angelis was arrested, tried, convicted. He was sentenced to 20 years in federal prison. He served 7. He was released in 1972, and in a coda so perfect it almost seems fictional. He tried to run another commodity scam shortly after his release. He was caught again. He spent more time in prison. Some people, it seems, never learn. Here's the uncomfortable truth that gets buried in most retellings of this story. Tino De Angelis was a crook. That's not in question. But the system that allowed this to happen, that wasn't the work of one man. American Express's field warehousing subsidiary failed spectacularly. Their inspectors didn't do the basic work required to catch a fraud that, in hindsight, wasn't that sophisticated. The banks that issued the loans, some of the biggest in America, outsourced their due diligence to third parties and accepted receipts at face value. Regulators weren't watching the commodity lending markets with any rigor. and the whole system operated on a foundation of institutional trust rather than institutional verification, nobody asked the simplest question: does this oil actually exist? Because asking that question would have implied distrust. And in the gentleman's world of 1960s American finance, distrust was considered almost rude. Critics at the time, and historians since, have argued that the banks and American Express bore significant moral and legal responsibility for the losses suffered by innocent parties. American Express eventually settled with damaged creditors for tens of millions of dollars. But no executives at these institutions faced criminal charges. Tino went to prison. The institutions paid fines and moved on. Sound familiar? The debate about individual accountability versus institutional accountability in financial fraud is one America has never fully resolved. This wasn't the first time it came up, it wouldn't be the last. Let's put the numbers in plain terms. The losses, total fraudulent loans, approximately $108 million in 1963, that's roughly $1.8 billion today. IRA Haupt & Co. forced into liquidation. Over 20,000 customer accounts frozen temporarily. Customers ultimately made whole thanks to the NYSE intervention. Dozens of banks and lending institutions left holding worthless warehouse receipts. Commodity traders who had taken the opposite side of De Angelis' futures baits, billions in market disruption. The fallout: American Express stock dropped nearly 50% at its lowest point, wiping out significant shareholder value before recovering. The winners: Warren Buffett's investment in American Express during the crisis generated returns, estimated to have multiplied his initial investment several times over by the time he began selling in the late 1960s, a foundational profit for what would become Berkshire Hathaway. The legal cost: American Express paid out tens of millions in settlements. De Angelis served 7 years. The regulatory cost: the swindle triggered congressional hearings and a fundamental review of commodity warehousing regulations, leading to significantly tighter oversight of field warehousing practices in the years that followed. The system, in short, was never supposed to allow this, but it did. Because systems, no matter how well designed, are only as strong as the humans operating them. And humans, given enough incentive and enough blind trust, they stop asking questions. The Great Salad Oil Swindle didn't crash the American economy, it came close. But what it did do, quietly, permanently, was expose something fundamental about how financial systems work, or fail to work. The fraud revealed that the bigger and more respected an institution is, the more power it has to certify reality. American Express's name on a warehouse receipt was accepted as truth by banks, by investors, by the entire financial ecosystem. Not because anyone verified it, but because they trusted the name. In the decades that followed, regulators slowly built more rigorous commodity inspection requirements. Field warehousing faced greater scrutiny. Third-party verification became more standardized. But the real lesson, was never fully absorbed. Because less than 40 years later, a company called Enron would use the same basic principle, the power of institutional reputation to certify a fiction, to build one of the greatest corporate frauds in history. And then came the mortgage-backed securities crisis of 2008, where rating agencies, the American Expresses of their generation, put their name on financial products that were essentially tanks full of water. And the banks took those ratings as gospel, and the system collapsed. The names change, the con stays the same. The salad oil is whatever they tell you is in the tank. So what do you actually take from this story? First, trust is not the same as verification. The banks trusted American Express. American Express trusted its inspectors. Nobody actually checked the tanks. In your own financial life, whether you're investing, lending, or being asked to sign something, trust the process, not just the name. Second, fraud hides in complexity and speed. Tino's scheme worked because the system moved fast and the details were complicated. Slow down when money is moving quickly and the explanation sounds reassuring but vague. Third, incentives create blind spots. The inspectors, the banks, the executives, everyone was making money. Nobody wanted to find a problem. Ask yourself, who profits from me not asking questions? Fourth, crises create opportunity if you're paying attention. Warren Buffett saw past the panic of the American Express scandal to the underlying truth. The brand was damaged, not broken. Most people sell in a crisis. The rare few who understand what they're looking at buy. And fifth, perhaps most importantly, the same frauds repeat across generations, not because humans are stupid, but because each generation has to learn the hard way that the fundamental rules of money, proof, verification, skepticism, patience never change. No matter how sophisticated the technology gets, no matter how prestigious the institution, someone somewhere is always pumping oil from one tank to another, hoping nobody looks to close. Tino De Angelis died in 2009 at the age of 93. He lived to see Enron. He lived to see 2008. One wonders what he thought. Whether he recognized his own reflection in those stories, or whether he simply thought, amateurs. If you think this kind of thing can't happen again, that the systems are smarter now, the regulators sharper, the names more carefully watched, history has a different answer. The question isn't whether the next great financial swindle is coming. The question is whether you'll be able to see the water beneath the oil. If you want to keep following stories like this, financial scandals, market collapses, and the extraordinary people caught in the middle, subscribe. We have more stories coming that will permanently change how you think about money. And drop a comment. What do you think is the salad oil of 2024? What's the thing everyone's accepting at face value right now that nobody's actually looking inside? I genuinely like to know what you think.